Hey everyone, welcome back to JC Project Freedom, the channel where we break down investing for financial independence in Singapore. Today we're going deep on a company that almost nobody is talking about, even though it has a 63% stock price gain in the past year. It's called ISOTeam, ticker 5WF on the Singapore Exchange Catalyst Board. I read 6 full annual reports. That's every single year from 2020 to 2025. Ran a full DCF model. Checked the accounting and stress tested the numbers. By the end of this video, you'll know exactly what this business does, why it's interesting, what the red flags are, and what I think it's actually worth. Let's get into it. So, what exactly does ISOTeam do? Here's the simplest way I can put it. They are the company that repaints your HDB block, waterproofs the roof, fixes tiles, upgrades lifts, repaints community centers, hawker centers, schools. Everything you see being done to Singapore's public housing estates. That's ISOTeam's bread and butter. They win government tenders, send workers in, do the job over 12 to 36 months, and get paid progressively as the work is certified complete. They listed on the SGX Catalyst Board in 2013, founded by two brothers, Anthony Ko and Eric Ko, who still control about 34.5% of the company through their holding company. And a Japanese firm called Taisei Ansho holds another 18%. So the founders and a strategic Japanese partner own more than half the company. That's actually a strong alignment signal, but I'll come back to that. The business has 4 segments. The biggest is ANA, addition and alteration. That's structural upgrades, lift installation, barrier-free access works. That's about 44% of revenue. Then R&R, repair and redecoration. That's repainting and waterproofing HDB blocks under government programs like the Neighborhood Renewal Program and Home Improvement Program. About 32% of revenue. Coatings and painting, CNP, is industrial and commercial repainting. About 11%. And this is actually the segment where the drone technology is being piloted first. More on that in a minute. And others, landscaping, pest control, building services, makes up the remaining 13%. The key thing to understand, over 90% of their revenue comes from the Singapore government or quasi-government bodies, HDB, town councils, JTC, NEA, and that's actually a feature, not a bug, because it means rock-solid payment reliability and zero credit risk. Now, before I get to the exciting stuff, I have to be completely honest with you about the dark chapter, because from 2020 to 2022, ISOTeam was frankly in serious trouble. In FY 2020, they lost 21.6 million Singapore dollars. In FY 2021, they lost 14.5 million Singapore dollars. In FY 2022, another 10 million Singapore dollars gone. Cumulative losses over 3 years, over 46 million Singapore dollars. On a company this size, that is enormous. And it wasn't just the losses. The auditors issued going concern warnings. That means they were flagging that the company might not survive. The banks had to give them covenant waivers, 3 years in a row, because the company technically breached its loan conditions. What caused it? COVID. The circuit breaker in April 2020 shut every single construction site in Singapore for 8 weeks. Then safe management measures stayed in place for 2 years, adding roughly 15 million Singapore dollars in extra costs across the pandemic period. Costs on contracts that were already priced at pre-COVID rates. They were stuck, legally obligated to complete old contract at old prices, but paying COVID-era wages and compliance costs. Now, the question you have to ask is, did management handle this crisis well? And the answer is, eventually, yes. Let me show you how. Here's where it gets interesting. Management did 4 things to fix the business. First, they sold everything that wasn't core. Pure Group, the fitness chain, gone. Sunseap, the solar energy stake, sold for 11.8 million Singapore dollars. SG Bike, TMG projects wound up. They raised over 16 million Singapore dollars in cash from disposals and eliminated tens of millions in non-core losses. Second, they did a rights issue in 2023, raised 9.2 million Singapore dollars to repair the balance sheet. Yes, that diluted existing shareholders by about 15%, but the alternative was potentially insolvency. It was the right call. Third, As the old COVID-era contracts ran off and new ones came in, those new contracts were priced at realistic post-COVID labor costs. Gross margin went from 0.5% in FI 2021, basically nothing, to 7.8%, to 10.1%, to 15.5% in FI 2024. That's a stunning recovery. And fourth, in FI 2024, ISOTeam paid its very first dividend, just 0.13 Singapore cents per share, tiny but a signal. We are profitable. We are disciplined. We are here for the long term. Here's the full picture in numbers. Look at that gross margin column. From 2.1% to 0.5% to 7.8%, then 10.1%, 15.5%. And we're tracking towards 16% in FI 2025. That is a legitimate operational turnaround, not accounting tricks. Actual margin recovery from getting better contracts at better prices. Revenue hit a peak of 130 million Singapore dollars in FI 2024, then dipped to 119 million Singapore dollars in FI 2025 as some large contracts completed. But profit actually held up well because the margins are so much better now. And EPS went from negative 7 cents in FI 2020 to positive 0.73 cents in FI 2025. That's the trajectory that matters. Okay, this is the part everyone is excited about. And honestly, I get it. ISOTeam is deploying an 18 drone fleet to paint building facades, 2 survey drones, 3 washing drones, 13 painting drones. They are the only local contractor in Singapore with this capability. 0 competitors. And here's the number that gets people excited. Those drones are projected to reduce the cost of painting by 30 to 40%. On a segment with roughly 13 million Singapore dollars in revenue, that's potentially 4 Singapore dollars to 5 million Singapore dollars in annual cost savings, flowing straight to the bottom line. The pilot program is launching around June 2026. And the Singapore government is actually supporting this. The Building and Construction Authority announced grants in April 2026 to help companies adopt robotics that achieve up to 50% manpower savings. Now, and I want to be clear about this, the drone numbers are projections. The pilots haven't happened yet. This is still a thesis, not a fact. But if it works, this is a genuine game changer. Let's talk about the customers, because this is one of the strongest parts of the investment case. HDB alone is roughly 40 to 50% of revenue. The 22 town councils across Singapore add another 20 to 25%. JTC, NEA, schools, hospitals, another 15 to 20%. We're talking about Singapore's government as your primary customer. These people pay on time, every time. Credit risk is basically 0. The trade-off is that ISOTeam is entirely dependent on government policy and budget allocation. If the government decides to slow down the HDB upgrading program, ISOTeam feels immediately. But looking at Singapore's commitment to maintaining its 1.1 million public flats, many of which are now 30 to 40 years old, and due for cyclical upgrading, this pipeline looks very durable for the next decade. What protects ISOTeam from competitors? Honestly, the moat isn't wide. This is a competitive tender business. Anyone can bid, but ISOTeam has a narrow moat in 3 areas. First, track record. 10-plus years of relationships with 22 town councils and HDB. You can't fake a track record. New entrants take years to build this. Second, regulatory barriers. BCA grading requirements, safety records, paid-up capital thresholds. These filter out smaller players from the major tenders. Third, and this is where it could become a wide moat, the drone technology. If ISOTeam can maintain first-mover advantage and potentially patent or protect their systems, their cost structure and painting becomes structurally superior to every competitor. That's the watch item. Can they convert first-mover advantage into a durable, hard-to-replicate edge? I always do a forensic accounting check on any company I analyze. And ISOTeam has 3 things you need to know about. Red flag number 1, the going concern history. I already mentioned it, but let me make it clear. From 2020 to 2023, the auditors flagged going concern risk. The company breached bank covenants 3 years running. This was a company in real distress. Now, That's largely resolved. No going concern note in FI 2024 or FI 2025. But you need to understand it happened. Red flag number 2. In FI 2023, ISOTeam changed how they recognize revenue. They switched from one accounting method to another and restated 2 prior years. The timing, their first profitable year, raises a question. Was this a genuine accounting improvement, or did it make the numbers look better? I can't prove intent, but I flagged it, and I think you should too. Red flag number 3, the management incentive plan. ISOTeam set up a performance share plan at IPO in 2013, and then made 0 awards for 9 straight years. Either management never hit their own targets, or the plan was never genuinely designed as an incentive. Either way, it's not a great look. They finally made awards in 2023, but the track record is weak. None of these are deal breakers for me, but they're eyes-open items. Okay, the part everyone wants. What is ISOTeam actually worth? I ran 2 valuation methods, a DCF and a multiples comparison, and then averaged them. On the DCF, bear case is 0.076 Singapore dollars per share. That's if the drones fail, margins revert, and the business just plods along with no growth. Base case, which assumes drones work and margins hold, comes out at 0.173 Singapore dollars per share. Blended fair value, 0.124 Singapore dollars. On multiples, at a sector average EV/EBIT of about 7 times, the stock is worth around 0.068 Singapore dollars. But if you apply a 10 times multiple to FI 2026 earnings estimates, which is reasonable given the drone re-rating story, you get 14 cents. Current price, 0.095 Singapore dollars. Against my blended fair value of 0.124 Singapore dollars. That's a 23% margin of safety. In my investing framework, I require 30% margin of safety for a full position. At 23%, I'm close, but not there yet. Here's the insight that I find most compelling about ISOTeam right now. I ran what's called a reverse DCF. Instead of calculating what the company is worth, you flip it around. Given the current share price of 0.095 Singapore dollars, what growth rate does the market need to see to justify this price? The answer? 0. The market is literally pricing in 0 growth. Forever. That means if ISOTeam just keeps doing exactly what it's doing today, the stock is fairly priced. You're not overpaying. But it also means any improvement, any growth at all, creates upside. If the drone program delivers even 3 Singapore dollars to 5 million Singapore dollars of extra annual profit by 2028, the fair value jumps to between 13 cents and 17 cents. That's potentially 37 to 79% above today's price. That's a pretty asymmetric setup. Downside, flat. Upside, drones work. Here's what the earnings runway looks like if the drone thesis plays out. FI 2026. I'm forecasting EPS of about 0.96 cents, up 32% from FI 2025 0.73 cents. FI 2027, 1.33 cents. FI 2028, 1.85 cents. And here's why FI 2028 matters. At the current price of 0.095 Singapore dollars, you're paying just 5 times FI 2028 earnings. 5 times. That's objectively cheap if those forecasts are even close to right. Now, forecasts for a small company like this carry wide error bars. These are my estimates. I built them bottoms up from segment revenue assumptions, margin expansion from drone adoption, and controlled overhead. But treat them as directional, not precise. Every investment has risks. Here are the 4 I'm watching most closely. Number 1, foreign worker levies. More than 60% of ISOTeam's workforce are foreign workers on S-Pass or work permit holders. If the government raises the levies, which it does periodically, margins get hit immediately. The drone program is a strategic hedge here, but it's not deployed yet. Number 2, drone delays. The entire re-rating thesis depends on the pilot program launching and working as advertised. A 6-month delay is fine. A 2-year delay changes the investment case. Number 3, fixed price contract overruns. ISOTeam bids at a fixed price and absorbs any cost blowout. This is literally what destroyed their margins during COVID. It can happen again. Number 4, government budget dependency. If Singapore's government slows the HDB upgrading program, unlikely but possible, ISOTeam's order book deflates at 186 million Singapore dollar today. There's good visibility, but it's worth monitoring. If I could sit down with Eric Ko, the CEO, here are the 3 questions I'd most want answered. 1. What's the actual return on investment from the drone fleet? Not projections, real numbers from the pilot. What's the payback period? Because the whole thesis lives or dies on this answer. 2. Can you maintain 15+% gross margins once the post-COVID contracts fully run off? Because right now we're at the highest gross margins in the company's history. Is that structural, because of drones and better pricing, or cyclical? 3. Why did the performance share plan make 0 awards for 9 years after listing? I want to understand whether management's incentives are genuinely aligned with minority shareholders. I put together a full list of 15 questions in the detailed research report. Link is in the description if you want to dig deeper. So, what's my verdict? ISOTeam is a conditional buy for me. I'm initiating a half position at the current price of 0.095 Singapore dollars. Here's my reasoning. The business has genuinely turned around. The balance sheet is repaired. Margins are the best they've ever been. The drone technology is a credible first-mover advantage with government support. And the market is pricing in 0 growth, which means I'm not paying for a story that might not happen. But at 0.095 Singapore dollars, my margin of safety is 23%, just below my 30% threshold for a full position. So it's a half position for now. I'll upgrade to a full position if either of 2 things happen. 1. The drone pilot delivers measurable cost savings above 2 million Singapore dollars per year, confirming the thesis in real numbers. Or 2. The price drops to 0.080 Singapore dollars or below, giving me that 30% plus margin of safety. This is not a get-rich-quick play. It's a small cap, a liquid stock on Catalyst. Position sizing matters. Don't bet the farm. Here's the full scorecard at a glance. Business quality, pass. Balance sheet, pass. Profitability trend, pass. Drone Catalyst, pass. Valuation, watch. We're just below the margin of safety threshold. Accounting risk, flagged. Revenue recognition change in the PSP gap. And no active tripwires, no regulatory probes, no legal issues, nothing that would cap my position size. Overall, a genuine turnaround with a real technology catalyst, priced at 0 growth. That's an interesting setup. That's a wrap on ISOTeam. If this kind of deep dive analysis is useful to you, please hit the like button. It genuinely helps more people find this content. Subscribe if you want to catch the next one. I'll be revisiting ISOTeam when the drone pilot results come out. That's the catalyst to watch. Drop a comment below. Do you own ISOTeam? What's your take? I read every comment. And the link in the description has the full 10-page research report, including the DCF model, 15 CEO questions, and the full forensic accounting analysis, completely free. This is from JC Project Freedom. See you in the next one.